All right, welcome to today's video. We're going to cover the factor that determines when AI winners become AI losers. I'm not saying the AI trade is over with, but there's definitely some evidence stacking up against it. If you read my latest newsletter, you're going to see that the five headwinds that were pointed out by Jim Cavella at Goldman Sachs are starting to play out as more of a worry across the entire market. And the focus of today is going to be on supply. Everyone likes to focus on the demand figure that we all got sold on without realizing that demand is fictional, right? That number can change. The orders and the contracts that are coming in and being touted by companies like SanDisk, Micron, and Samsung can all be pulled away if the economics stop making sense. Now, demand is fictional, supply is real. And this week has been more than enough evidence to see in the price action that most of the memory and semiconductor trade is now past the correction and going into a bear market territory because more players are coming online. More players are realizing, well, there's a lot of money to be made if we simply keep investing. And when you overinvest, you overshoot supply, that kills margins, return on capital, and eventually valuations. So today we're going to focus on the demand story and the supply fact, right? So first, the frame, right? Forecast and demand is more of a guesswork, right? You could forecast all you want, you could do the numbers all you want. That only tells you more about the analyst behind the forecast, behind the projections, rather than the reality, right? Because everyone can have a story or an opinion on demand, right? I can tell you that demand is going to be weak. Someone else is going to say demand is going to be strong. Who's right? Nobody knows until time goes by. But when you look at supply, no one can say supply is strong. No one can say supply is weak because the numbers are there, right? And when you have roughly $725 billion of physical oversupply heading into the market, that's only on the hyperscaler side. Then you have Chinese, Japanese, Korean, and European players starting to come into the industry and increase the capacity for chip making, for memory, for fabs, for data centers, and that all starts to have an effect on the amount of supply compared to the unstable, fictional demand numbers that we're all getting told, right? Just this week, in fact, ASML reported earnings and they said they're going to increase capacity by 60% over the next 2 years. TSM, Taiwan Semiconductor, they reported earnings this morning, and they said that they're going to increase significantly the amount of capex that they have been doing. So, of course, they just announced $265 billion into a new U.S. capex project, right? So what that means is there's a lot more money going into the supply side than there is coming from the demand side. So I want you to focus on that because that's the fact. Then we have a capital oversupply, right? So physical oversupply is one thing when you have the data centers, the fabs, the chips, and capital oversupply is the other, right? So we have bank earnings that came out this week pointing to the capital cycle potentially peaking, and we're going to cover that in a later slide. But just know that this isn't about physical supply alone. This is about capital supply also. And we have too much capital chasing a limited amount of goods and a limited amount of projects. Then the prospects of those projects and the cheapness of that money starts to act as a headwind. All of that leads into a rotation. I believe the capital cycle, the memory cycle, the computing cycle, and everything else is going to act as a rotational trade, which is already starting to play out in the halo trade and the real economy trade that I posted about in my last video, and it's also inside the Offside newsletter. So let's get into it, right? The rotation begins with a cheap cyclical PE. Now, this is a trap. It's not a gift, right? Most people like to quote that Micron, because it trades at 6 times forward PE, is a value play, it's a dip buying opportunity, and everything else, right? When you look at PEs, you have to realize something, right? Defensive stocks with recurring revenue, with non-cyclical products like subscriptions, like software, like conglomerates, right? You look at a Costco, you look at a Walmart, you look at most of these companies that have very little cyclicality to their products, they deserve to trade at a more expensive multiple, right? Because the earnings and the revenue is always going to be stable, and as long as they post steady growth rates, then that multiple premium is justified and is sustained. Now, when you have cyclical stocks like chips, semiconductors, and memory, that tells you a different story. When they become expensive, such as Intel in earlier last year when it was trading around $20 a share, I pitched it out on my Twitter and also in the newsletter. I like the stock, even though it was trading over 100 times forward PE. So what does that mean, right? When you have a cyclical stock that trades that expensively, it means the market expectations for earnings are getting better, not worse. Now, at the same time, Nvidia's multiple compressed, right? Everyone's talking about that as well, where the forward PE multiple for Nvidia has compressed roughly from the 30s and 40s down to the low 20s, high teens, and they're calling that a buying opportunity without realizing that it is a cyclical business. The products that they sell and manufacture are cyclical. So when the market starts paying less for the future earnings of these companies, it means that the earnings expectations are getting worse. Now, if you fast forward that trade, Intel massively outperformed Nvidia, even though it was the most expensive stock in the pure set, right? So right now, a cheap Micron at 6 times means that the market is priced in a down cycle, not a bargain. And we're starting to see the reasons why that is in the supply that's coming in online, right? So the offside flip, the reasoning that we'd like to have behind this is the same as with expectations, right? So expectations investing begins with asking what must be true for today's price and tomorrow's price to hold, rather than what am I predicting, what am I forecasting, right? And when you look at the Nvidia expectations, markets, in order to justify today's price, today's market cap of 5 trillion, the company has to grow revenues by 47% a year for the next decade uninterrupted. I think that's unrealistic because it would get them to $12 trillion in revenue by 2031. Again, I don't think that's realistic, but when you look at something like a Lululemon, right, and that's another deep dive that I'll link down below, the market is pricing in a negative 1.5% revenue growth for the next decade. So I don't think that's realistic either. So you could look at that framework and find deals that hit you in the head with a brick and say, well, that's unrealistic to the upside or unrealistic to the downside, and that's where I can make money. Now, the same thing can be said about demand and supply. Everyone likes to focus on demand, which is essentially the same way that we do expectations investing, where people focus on the future projections rather than what's embedded already. In that same framework, I want to focus on supply, not on demand. Now, the supply here is the answer, and it's the scarcity that everyone said it was going to last for the next 5 years. Well, there isn't scarcity anymore, and the supply is coming back online. It all begins with the $725 billion capex from the hyperscalers. That is the projection for 2026, along with new players coming online, right? So you have China, CXMT already landing a deal with Apple. You have ASML, you have Taiwan Semi, you have Tower Semi. All of these Asian players and European players are coming online, right? Whether you like it or not, whether you believe it or not, as far as the quality and the adoption rate of these Asian chips, it doesn't matter. What matters is that supply is increasing. Whether that supply gets adopted or not doesn't really matter, because the market dynamics are changing, the margins are changing, the bottlenecks are changing, right? So you have the Japan, South Korea memory capacity expansions, which are very, very aggressive. That's happening as well in Europe, in the US, and in other nations that are leading this race. So that didn't used to exist before, and now we're seeing it come online, which directly changes the overall economics of the AI trade and the margins for these chip makers. Now, when you overshoot, it always collapses, right? And history rhymes, or at least it tends to repeat in many similar ways. So you had it in the 2008 housing collapse, where home builders saw the massive margins that were to be had in the early 2000s and said, hey, well, people are making money, our competitors are making money, so we have to invest at the same aggressiveness or intensity or even more, right? So that's when you had The first hyperscalers, let's call it Amazon, and then Microsoft came in and said, well, we can't have our competitor beat us out on the AI race, so let's invest even more. And then Meta comes in and says, well, our competitors are investing and are beating us to the punch, so let's invest even more. And what happened now is you have a bubble of over investing and capital oversupply in these entire trades, so margins are gonna go bust, and they're already starting to do so. The second example is the dot-com bust, right? So you have the internet infrastructure, which was overbuilt compared to the demand expectations in the 2000s. So demand expectations for internet traffic and internet users didn't fulfill, right? So again, this goes back to the point of demand is fictional, and those numbers tend to change, while supply is set in stone. Supply is the fact. Then you also have the lost decade in Japanese banks. They overbuilt and they overgrew their balance sheets, and they overinvested into the amount of assets that they could hold, and that ended up having a negative effect on margins, on return on capital for the banks, on liquidity capacity, and that led to a collapse in the economy for Japan. Now, when we look at the anomaly, the phenomenon here that's happening, economists call it the asset growth anomaly, right? And this is a short term effect that turns into a longer term effect in a different way. So, bigger balance sheets and lower returns is the core concept. In the beginning, right, in the short term, when you expand your balance sheet, when you expand the amount of book value that you have in a company, that tends to be good for the stock price. That tends to have a positive effect because investors, CEOs, management teams, investment bankers are incentivized to grow the asset base as quickly and aggressively as possible. Now, short term, again, that's good, but long term, what happens when you start issuing stock, right? You start over investing into capacity, you start over investing into bloated balance sheets. The returns go lower, right? And this is essentially the opposite effect of paying a dividend or buying back stock or refinancing or having M&A activity to consolidate the industry. What you're doing here is you're expanding the industry and you're fractioning every single player. So the margins overall, the returns overall on the industry level go down. And what you're seeing that here is a massive boost in the asset growth anomaly coming from the capital deepening in the hyperscalers. So capital deepening, if you look at China, for example, the Chinese market has done nothing for the past 20 years because the country keeps investing and over-investing into infrastructure and everything else. So why would a country that invests so much into infrastructure and technology underperform a country like the US, which barely invests anything? Because when you expand the balance sheet by that much, the returns go lower. And that's essentially the setup that we're seeing here for the hyperscalers and everyone else in the AI trade. Now, there's a sweet spot for CapEx, don't get me wrong. You have to invest. You have to invest to keep growing and keep having relevance in your industry and against competition. But again, there's a sweet spot. When you look at this chart, this is the historical predictors for CapEx and returns, right? So when you regress the two, you're trying to answer the question of how much CapEx leads to the most return on assets, right? And when you look at here, the CapEx intensity, when it goes too low, right? So roughly 1.5 to 2.5%, you have mediocre gains when it comes to assets, roughly 7% to 8%. Now, right at the other side, on the right-hand side, you have CapEx growing at double digits, so like 15%, 16%. That tends to give you the lowest return on assets, even below when you don't invest at all. And right in the middle is where the sweet spot is. When you invest at a CapEx intensity of, let's say, 6 to 7%, that's when you get the most returns on your assets at roughly 15%, right? So what this means is you can't overinvest. That is the worst outcome. And you can't underinvest because that's the mediocre outcome. So right now, the question is, are these companies over-investing, investing the right amount, or under-investing? And right now, the return on assets and the margin compression shows us that they're potentially over-investing in this case. Now, the semis have already peaked in that return cycle, right? So when you overinvest, remember the initial cycle tends to be reflected in a boost in returns, and then it ends up becoming a return compression, which leads to valuation and earnings compression. So you look at the return on assets by subsector. You had the peak in semiconductors right around 2022, 2023. And now you're starting to see the effects, right? So Nvidia is lagging the entire sector. Nvidia is lagging its peers because there's now 3 years into it where returns are compressing for the entire industry. So what's hot right now is logic, compute, and memory. So I'm not saying that it's going to peak anytime soon, but when you look at this chart, the peak and the spike, right, could be getting close to a cautionary tale. I'm not saying it's going to turn anytime soon again. The timing this is almost impossible. But what you can say is historically, we're at the highest levels of profitability for the memory and logic trade. So what that means is the tendency is for competitors to see this and say, well, there's a lot of money to be made, in the logic, compute, and memory space. So let's get into that business. And you see companies like IBM starting to go into it. You see companies like TSEM, TSMC, all of these players starting to get into it because they want to have that similar rate of return. So that's what tends to happen. You have a lot of competitors coming in, a lot of players coming in. The supply expands beyond what it needs to do. And essentially, you have the peak in the ROA cycle, the turn and the bottoming, and that leads to stock price action, as we saw on the previous chart. Now, this is where it matters, right? Wall Street isn't really helping, and Wall Street bankers drive the capital cycle by having accessibility or containing accessibility to capital markets. And when you see the rotation in the free cash flow flip is all going from the hyperscalers into the semiconductors. And we just saw what happens when you have an oversupply of capital and an oversupply of physical capacity. Returns on assets go down, as we just saw with semiconductors. I think the next stage is going to be memory and compute. Again, not saying that this is the top, but it's definitely towards the later innings of the entire trade, just judging by the capital cycle, right? And it all began with the hyperscalers. So the ones that funded this entire thing could be the ones that stop it in the first place. And we all know the narrative of CapEx. If it slows down even by a little bit, the entire AI trade pops. I agree with that. We're starting to see Amazon already saying they're not going to finance any more CapEx for 2026 after a recent $25 billion round. So what happens 2027, nobody knows, but it's looking like it'll be tighter CapEx. So when that happens is, it'll be up to debate, but I think the entire AI trade could be in trouble from that. Now, this week we had big banking earnings from Goldman Sachs, Bank of America, Citi, and JP Morgan. And like I said before, the investment bankers and the big investment banks are the ones that drive the capital cycle, the capital supply, the capital overinvestment or underinvestment cycle. So right now you see one single trade, which is the AI trade, the long global semiconductors having 82% concentration, which is historically the highest level of concentration ever. So everyone's betting on this trade, right? That's pretty clear from a professional and the retail perspective. Now, banks, the ones I mentioned, Goldman Sachs, Bank of America, Citigroup, JP Morgan, they all posted record profits. Now, these profits are not coming from the same area, right? So these investment banks, they make profits from lending fees, right? So lending spreads, lending activity, which is essentially loans and financing for companies and corporates and private clients. Then they make money from the capital markets, which is essentially prime brokerage, trading, sales, refinancing, and everything else. And then you have investment banking fees. So you have M&A activity, you have IPO activity, you have equity and debt issuance activity, and that's essentially where most of the profits of the banks came in. Now, the lending activity, the asset growth activity is where the economy seems to be more defensive, and it makes sense, right? People are taking on loans, they're not taking on risk, and then equity is not being issued. There's not a lot of M&A activity because valuations are depressed. And today, you're at the other end of that curve where most of the earnings came from IPOs, record levels, right? You have SpaceX, you have the SK Hynix listing, you have OpenAI and Anthropic coming in online potentially this year or next year. Then you have record equity issuance from the hyperscalers that can't afford any more capex, so they have to raise money by issuing shares or issuing debt. So all that record issuance is showing up at the banks, right? And nobody talks about that, but that is usually when the capital cycle peaks. And here's a clearer chart of what's being done here. So roughly $4.1 trillion went into the S&P over the past quarter. And this is reported by the banks, right? So you have IPO proceeds, roughly 1.3 trillion. Then you have global equity capital markets issuance. This is companies issuing stock, right? So you have MicroStrategy is one of them, Google, Amazon, Meta. All of these companies are issuing stock because they cannot afford to keep investing the capex intensity that they've taken on. Then you have investment grade corporate debt issuance. So this is bond issuance, again, by the hyperscalers, by other companies that can't afford to keep sustaining the capex intensity that they've taken on. And then you have convertibles, right? So that's another sort of issuance, convertible bonds, preferred stock, and all of that, follow-on issuance. So what this means is roughly 6% of the S&P's market cap was issued over the past quarter. And what that means is essentially the opposite of when you buy back stock, when you pay a dividend and you return money to the shareholders, you're essentially destroying value when you do this. And it makes sense. I mean, stocks are expensive. Now is the time to issue expensive stock and finance all the shenanigans that's happening in the market. Now, for years, stock was bought back, right? So the tendency for the US is to buy back stock. And you see it every time that we stop buying back stock and start issuing stock. That's when market peaks tend to happen as well. So you have 2008, right? 2009, we started issuing stock, we had the market decline, and then we started buying back stock. We started roughly a 12-year bull market. And then 2021, we started issuing stock. So that's when you had a bunch of IPOs, the SPACs mania that came in. The banks were reporting record earnings from investment banking fees, from sales and trading, from equity and debt issuance, such as today. And then you had the 2022 bear market where we saw the opposite. We started buying back stock again, and we saw a continued bull market, and now we're issuing stock, right? So we're issuing record levels of equity and debt and IPOs, and the banks are showing it. So what happens here is we not only have a physical oversupply of goods, we have a capital oversupply, and that never ends up well. And unless the market mechanics have changed forever, I don't think this time is going to be different. Now, we have the issue not being in the issuance itself, right? So it doesn't matter if you issue stock, it matters at what valuations you do it, right? Because you increase supply when the product is cheap and the product is valuable. Demand is going to come right after it and it's going to absorb all the supply, and things are good. Now, when you look at the valuation for the S&P, you have the earnings yield, which is essentially 1 divided by the PE multiple. Given that the S&P trades at roughly 32 times earnings, that earnings yield is roughly 3%. Now, the red line here, inflation is roughly at 4%, 3.5%, 4%. So you're getting a negative yield essentially on the S&P. Now, when you start issuing record levels of equity at record levels of high valuations, that's not a good mix. That's when you start destroying value. That's when things get worse for the stock market. That's essentially a headwind, especially if you issue such a big amount, 6% of the market cap issued at negative yields. I mean, whoever buys this crap is going to lose money. That's essentially the math behind it, not the timing. But if from inception you buy into a negative yield deal, you're going to lose money at the end of the day. So that's the mathematics behind this all. Let's see here. So you have more on the banks, and nobody really paid attention to the bank earnings other than the record revenue, the record earnings, the record numbers that they posted. But like I said, there's two ways that the banks can make money, either from capital markets or from lending activity, which is net interest income, right? So you have the curve here today looks a lot different than it did, let's say, the bottom of 2022, because right now most of the earnings are coming from equities trading and financing and investment banking fees. So risk taking is so high that these banks are making a ton of money, billions, decabillions, on equity trading, because all the prime brokerage business, all these sales and trading business, all their clients are all in on equities right now. And again, they're not looking to stop it anytime soon. Now, on the second hand, you have the investment banking fees, which is the equity issuance, the debt issuance, and the IPOs. That's where the profit center was for the past quarter. If you look at the same curve for 2022, most of these banks made most of the earnings in net interest income and in fixed income trading. So people trade bonds and fixed income when there's not a lot of risk taking appetite. And same thing with net interest income. That's when people do the most lending, they borrow the most money, they try to sort of get the capital cycle to bottom and then restart again. And right now it's quite the opposite. People are not taking on the financing, they're actually issuing everything. So they're getting rid of everything. And there's not a lot of fixed income trading. There's not a lot of net interest income, which tells you the banks are at the top of the risk taking curve. Now, every gauge is pinned at a market peak extreme, right? Everything I talked about today tends to align with previous market peaks, such as the 82% concentration on the surveys going into long semis, right? Then you have the concentration of the market itself, right? You have 20% into semiconductors, another 15% into memory, another, I think it was 42% on the big AI players. So all that combines to over 50 to 60% concentration of the S&P into one trade. That usually marks the top or close to the top. Now you have 6% of the market cap being issued. That tends to align with tops, as we saw in the previous chart, the 2008-2021 tops. We have all-time high household margin debt and all-time high household exposure to equities. And that's never good, because that's when retail gets crowded into one single trade. They take on debt, they take on loans, they take on margin to bet into all-time high valuations, and that never ends up well. So get 1929, right? Now you have a 3% earnings yield on the S&P, below inflation. Every time we get below inflation, and market top tends to come in very, very close around the corner, right? You have to have a positive yield, otherwise you go into a lost decade. Again, last time we had a negative yield on the S&P was in 1999, and the stock market did nothing up until 2012, right? So we are set up for a lost decade with record margins, with record concentration. So it's not looking pretty great for a generalist, right? If you're an individual stock picker and a rotational picker, you're gonna have a great time. Now, speaking of rotations, right? I think the market is going to rotate into higher yield and higher growth winners, such as the halo trade. And you can look at the sector spreads for earnings yields that are above the market, right? So anything above 3%, and then anything that stands out on EPS growth for the next 12 months, right? So that's very easily spotted here. And the alpha is in retail, wholesale, transportation, automotive, and then the overweight software trade, which is the rotation or the antithesis to the AI trade. So if the AI trade fails, I think the first winners are going to be the software names that we already pitched inside offside premium in the newsletter. And then the secondary winners, as far as rotation, based on the yields, based on the EPS growth, I think it's going to be retail, wholesale, which makes sense. I mean, inflation needs to come down. Rates are doing the thing, and then the opening of Hormuz could rebound the all-time low consumer confidence readings that we're getting. And we're already playing a specific trade in the cyclical sector of apparel. So we have an equity and an option sleeve playing there. I'll link it down below as well. And we're putting together a defensive trade as well this week. So stay tuned. Same thing. We have the fuel cost affecting transportation. So as soon as the Iran war is over and we start to see normalization of supply chains and fuel costs, I think that transportation could be one of the areas that benefits by a ton in the coming quarters. So that's, I think, why the yield is so high and why the earnings growth is so high right now. And then, of course, software, as already mentioned. So right now, you've gotten the thesis, you've gotten the setup of why this could be the timing of when AI winners start to become AI losers. You got the areas that I want to rotate into, and you got the overall halo trade already pitched out to you. You have the capital oversupply, the physical oversupply. Pretty much you have every single mix that you need to start thinking about your portfolio, start thinking about your exposure and whether you're betting on this theme or against this theme. And that should tell you where the innings are for your returns. Now, behind the paywall, and I'd like to remind you that tomorrow, Friday, prices go up to $249.99 a month, up from $59.99 a month. This is all due to supply and demand, right? Everything we talked about today. There's a lot of demand. I have a limited amount of time. And quite honestly, the returns that we've been getting for our members are way above the annual cost of this membership. So it only makes sense to increase prices. I owe it to myself and my partners. So behind that paywall, you're going to get the memory compute long short equity trades. You're going to get long-term value areas that I'm investing into, whether it's through equities or equities plus options and whatever structure I find necessary in today's market. You also get a live portfolio update every single day with target prices, hedges, DCA alerts, everything, right? And you're also going to get a chance to interact one-on-one whenever you have a question on your portfolio, on a specific stock that you like covered. If I find that I'm capable enough of covering that stock, I'll be happy to send you a personalized report and all that good stuff. So again, prices go up tomorrow. Make sure you lock in today's lower price and keep winning alongside us. The portfolio is already up roughly 4% over the past month, and we've all seen what the S&P has done. So enough said there. Now the rotation is starting, right? We have the Sunday morning emails that I send every single week covers the factor, performance, and exposures. And right now, it seems that the momentum trade is losing, the growth trade is losing, and the rotation is starting. So again, make sure you don't watch it from the sidelines. Join Upside Premium. You're going to get every single trade and every single rotational idea that comes to our desk right into your inbox. And that being said, I hope you get a lot of value out of today. I'll catch you in the next one, and we'll see where the supply-demand dynamic is after the big names in the trade in the AI sector report their numbers this quarter. Again, we're going to post all about it in the newsletter. I think there's going to be a lot of content when it comes to these earnings numbers and the implications for each stock and the overall AI trade. Be safe out there, guys. Let's make some money this month, hey?